We get Maithili's perspective on the macro situation too. She joins in, Maithili Samrat, consulting editor ET Now, with her views, and Sunil Sinha, who's principal economist and director at India Ratings and Research, also joins in with his perspective. But Maithili, I'll start off with you. Good afternoon. Many are seeing this bounce back or this rebound rally as being fueled by the ECB's comments. The expectation is come March, the Fed would perhaps take a pause, not hike as per expectations. On the other hand, the ECB, aside of the extension to QE, may look at really deepening the kind of QE that they've done so far. How are you looking at the global setup this afternoon, and how much do you read into it?
Well, I think the uncertainty really hasn't come down. We have seen some reassuring comments, not just from the ECB, but also from the RBI governor as well as the finance minister. But markets are exceedingly skittish. So at a time like this, one doesn't really know what they're going to cotton on to. The worry really is whether we really seen the end of the pain emerging from China. So I would not read too much into today's bounce back, just as one shouldn't get too despondent about the falls when they happen, because I think until one gets a firmer picture of the global recovery, we are going to see these extreme reactions both ways. As for the idea that the Fed might hold back, it's a little too early to call, because March is still a long way off, and many things can change, as we've seen, that almost macroeconomic indicators, it's not just the dollar or the Sensex that is behaving like a Sensex should, up and down, almost crazily. But almost everything seems to be reacting like that, whether one is talking about global reactions, FII flows. So I think it's a little early to take too much reassurance from the recovery, but because broadly I would suggest that we are still very deeply in the woods. Yes, India is looking better, but that's only relatively so, and it's only a matter of time before we catch up with the uncertainty in the world, unless the uncertainty in the world really comes down completely. And that, I think, is a little early to say, because though there are signs of recovery in the US, latest data that we see from the US is not entirely satisfactory. So I would just kind of say that reactions both ways are extreme, and one needs to kind of basically hold one's horses, reserve one's judgment, and say, yes, the economy is still in the woods, we are recovering globally as well as internally. And so I think right now one has to just hope and pray that things don't completely collapse, because recovery on that same dimension is a little far and bleak at the moment, but things are really not as bad as markets will have us suggest. Then that's my take on it. But I really do not know whether Sunil shares that view. Do you, Sunil? That markets tend to overreact both ways, and broadly speaking the recovery is there, it's slow, it's painful, but it's still there. Sunil?
Yes, absolutely. I mean, if one looks around and see how India is placed in the global context, then certainly as opposed to a lot of its peers in the emerging economies, whether you talk about Brazil, Russia, and now even China, and India certainly is much better placed, because a number of macro variables, whether you look at inflation, whether you look at current account deficit, whether you look at fiscal deficit, I think things are much better in the Indian context as compared to some of its peers. So from that perspective, definitely we are in a better position, but global headwinds will continue to weigh on India's recovery process. And as we have seen time and again, and we are seeing even now, that capital inflow, outflow would be a cause of worry, which will have its both stabilizing or destabilizing impact on the currency. Similarly, this is also a very difficult time so far as businesses is concerned, because in uncertain times it is not very easy for you to take a call about the future, and as such the investment recovery is very slow and painful. So in my view, if the volatility continues, which looks likely, at least in the near term, that will have some adverse impact on India's growth process. But on the whole, I guess because we are largely a domestic demand driven economy, I think to some extent we are insulated, or so to say are independent of the global factors, and probably we will continue to perform better than some of our peers.
Yes, that certainly has been one of our greatest strengths so far, that we are largely internally driven. But have we seen the worst news emerge from China? More pain to come, number one. And has the world at large factored in this worst case scenario from China? And so do we not have to worry anymore about what comes out of China?
Well, I mean, certainly, I mean, in PPP terms, China is the largest economy, and even otherwise is the second largest economy. And the problem is that, I mean, such a large economy, if, behaves somewhat differently than what most of the economic agents have been expecting it to behave, then certainly any news which is not very pleasant or which is unexpected, if it emanates from China, it will lead to its impact on the global economy. And in fact, I mean, although we are rejoicing, and so far as India is concerned, the decline in oil prices is a big positive, I mean, for us. But let's not also forget that it has a very adverse impact on a large number of oil exporting economies, and particularly the Gulf. So, for example, if the Gulf economies don't do well, I mean, it will have its implication not only for our exports, but also the remittances that we keep getting on a regular basis. So obviously there are both positives and negatives, but I agree with you, Maithili, that perhaps the worst is yet to come so far as Chinese economy is concerned.
On the issue of fiscal deficit, I find India Ratings and we are on the same page, but we seem to be in a minority on this, because almost all the editorials of the paper seem to be suggesting that India should stick to that very rigid timeline laid down for the fiscal deficit. You seem to take a more relaxed view, considering the peculiar circumstances that we are in. But is Fitch perhaps the outlier in this? Because I find the other rating agencies also tend, both Standard, S&P as well as Moody's, also seem to take a slightly more relaxed view, but most of the other brokerages, etc., seem to take a very much more rigid view, including in fact some of the government spokesmen. They've all made it a point to assure the public at large that it will stick to the fiscal deficit target. What makes you think that a more relaxed target will not do tremendous damage to our credibility or to our rating?
Maithili, I think one of the important thing to look at, when we talk about fiscal deficit is both as a ratio and as an absolute number. I mean, what can really be destabilizing for the capital markets is if the quantum of money which government is borrowing really goes up. From that perspective, we don't see any slippage, because by and large we believe that the fiscal deficit in absolute numbers is not going to go up. However, because of the nominal GDP really falling well below what was budgeted for, I mean, as a ratio, of course the fiscal deficit will be higher. So my own assessment is that I think this particular aspect needs to be very much taken into account, because one of the fear is that if fiscal deficit is high, it will have its impact on interest rate, and it will somewhere crowd out the private investment and so on and so forth. So, I mean, with absolute fiscal deficit remaining at the same level, I think that question doesn't arise. That's point number one. The point number two is that in any case, private investment is down and out for various reasons, of course. So under such circumstances, everyone is perhaps looking up to the government to actually undertake or even increase the capital expenditure to revive the investment cycle. So, I mean, if the borrowing or the additional borrowing or a higher fiscal deficit is typically used for capex, then I think it is only going to benefit the economy in the medium to long term. So my own or our view at India Ratings would be that that's a plus for the economy rather than negative. So, but yes, again, I mean, this is something which has to be used, or this window has to be used very selectively and very cautiously. That we have seen in the past that once you relax that, you tend to lose the sight of fiscal consolidation. So, I mean, under the current circumstances, if this window is used to increase the capex, well, I think it will be a big positive for the economy.
I couldn't agree with you more, Sunil. I do hope the government listens to both of us. In fact, there's an interview of the chief statistician T.C. Anand, which says the problem really in India is that many of the analysts don't understand the data. He was talking in the context of the GDP data as well as the divergence between CPI and WPI, where he goes on to say that problem really is in the composition of the basket that constitutes the CPI and WPI. So given that kind of difference in the composition and given the kind of different signals that the CPI and the WPI send, do you think the RBI has erred in taking CPI as the target and completely ignoring what happens on WPI with the consequences that we have seen for its policy formulation?
Well, there is a risk. I mean, if you use the WPI or CPI, I mean both. In the past, we have seen that when RBI's nominal anchor was WPI, there were a different set of problems, and now we are in a situation where what we are witnessing is, I would term it a kind of a mixflation, because what you are witnessing is that one set of commodities are behaving in a very different manner than the another set of commodities. I mean, say for example, in the Indian context, I mean the entire food basket or the food inflation behaves very differently from the other inflation, and to some extent the fuel inflation or manufacturing inflation obviously are behaving differently. So under that situation, ultimately it depends as to which one has a higher weight in the index, and that's what will determine the overall character. And as we have seen that fuel inflation has been significantly lower, and also manufacturing inflation hasn't picked up because the demand hasn't picked up. So largely WPI is in negative territory, whereas CPI is in positive territory because you have a higher weight of food inflation. So my own sense is that of course, I mean, for RBI it is very difficult, but I would tend to agree with you to the extent that using CPI and not keeping an eye on what is happening with the imported component of inflation or for the manufacturing inflation, somewhere it will RBI may be somewhat off the mark. So perhaps one will have to be more cautious in terms of really looking at the inflation numbers as they are thrown either by CPI or WPI, and probably take a more nuanced view and convert them into the policy rates.
I'd agree with you there too, Sunil, but we've just seen the governor dismiss the suggestion that came from Arvind Panagaria that we need to relook the monetary policy framework, because he said it's perfectly fine, you can't keep changing it from periodically, which is also true. But given the fact that the monetary policy framework, that inflation targeting approach that you've taken, focusing on CPI, doesn't seem to have led us very well as far as GDP growth is concerned, maybe there is a case for a relook. So what kind of policy action are you hoping the RBI will take? Do you expect to see any repo rate cuts?
Look, I mean, so far as fiscal year 16 is concerned, our view is that more or less we are done. I mean, it's unlikely that there will be another rate cut. But as we move into fiscal year 17, as I said, that to a large extent, the CPI, which is the nominal anchor for RBI's policy, happens to be CPI, and food is an important driver of what happens to CPI. So a lot would depend as to what kind of a monsoon prediction the Met would do for the current calendar year. I mean, although the expectation is that it is going to be a normal monsoon, because in the last 100 years or so we never had a 3 consecutive bad monsoon. So to that extent, although there is a reassurance, but I still feel that RBI would probably, wait till April or May, by when more or less it becomes clear whether we will have a good or a bad monsoon, and then that will help RBI to take a call in terms of rate cut. But our view is that if monsoon remains normal, then there is a scope of anywhere between 25 to 50 basis point cut in the next fiscal.
Okay, well, that's a very interesting point there, and of course we'll be all watching out to see what kind of monsoon 2016 really throws up. Thank you so much, Maithili, as well as Sunil, for joining in this afternoon with this very interesting discussion there. But with the markets on a clear high right now, we'll slip into a quick break, and as we do that, let's hear out George Soros talking about the Greece concerns which he believes are likely to resurface.